Singaporeans are taking on more debt, and this should concern you. Let's talk about this today. Hi guys, welcome back to the channel. Today I want to talk about something that doesn't get discussed enough, the rising debt of Singapore household and why it has become a concern in the real estate market. In recent Business Times article, it has highlighted the worrying trend of Singaporeans household taking on more and more debts. And the household borrowing continues to climb without showing any signs of slowing down. And this has happened since late 2024. And also a large proportion of that comes from the mortgage loans. Now, before we talk about strategy, opportunities, or leveraging, we need to ask this one very important question. Are we becoming too comfortable with taking on more and more debts? If you like this kind of content that helps you avoid costly property mistakes, do hit the like and share this video with your friend. This will really help the channel a ton. Thank you. So why is rising debt a concern? When national household debt rises, it usually signals a few things: bigger loan commitments, longer payment horizons, and higher sensitivity to rising interest rates. That is when debt magnifies risk. In today's environment, especially just coming off that high interest rate environment, many will feel that the debt is very manageable. And that's why I think this is a good time to bring up this topic again to remind everyone of managing your risk. The installments look okay and the cash flow looks under control, but when interest rates move up again or when income gets disrupted and with rising household expenses, debt doesn't change. That is why excessive debts reduces resilience. Let me give you an example. I help many upgraders in their upgrading journey a lot, and upgraders actually form a big part of this story. Typically, what happens is a family buys their first property 5 to 10 years ago, installments become very manageable over time and they feel comfortable, and then they upgrade. When that happens, installments increases again. If you have been following my channel, you will know that the 2.5 million at this present moment is the sweet spot for anyone who wants to upgrade to a 3-bedroom private condominium. And at this price point, you are going to increase your monthly mortgage installments by a few times. So assuming you are buying a $2.5 million private property, the 75% loan will be 1.875 million. And if you can take a 25-year loan tenure at 1.45%, you are paying $7,455 per month. That seems affordable today. But what if the rates goes up back to 3.5% or more? At 3.5%, you will be paying $9,387 per month. So yes, you can afford it today. But affordability today does not equate to resilience tomorrow. A move back to 3.5% interest rate, which just happened like a few years ago, increases your monthly repayment by almost $2,000 per month. We must recognize the fact that interest rate does not stay low all the time. And when you commit into a property purchase, it is easily a 20 to 30 years commitment. That is why a rising debt should be concerning to us. So if you're upgrading and haven't stress test your numbers yet, reach out to me over here and I'll be happy to give you a full-on consultation. But here is where the conversation needs to mature. If rising debt is automatically disastrous, Singapore household would already be in serious trouble. Yet the data shows something else. Despite rising liabilities, Singapore household total assets continue to exceed their debts by a wide margin. If we take a step back and look at the macro picture, it is not just about debts. It is about what sits on the balance sheet. In fact, in the same article, while talking about the rising debt, it also highlighted that household assets are growing faster than liabilities. Net household worth continues to increase, and property remains the major component in these assets. This tells us something important. Singaporeans are not borrowing just to spend. In fact, they are borrowing to buy into assets. One key thing people don't realize is debt gets smaller over time. And that's not just because you repay it down. Let me explain. For example, you borrow 800,000 to buy a property. 10 years down the road, you would have already repaid the loan to a balance of around $500,000. $500,000. But here's the point most people miss. $500,000 in 10 years time is not equivalent to $500,000 today. And the reason for that is mainly inflation. Money loses value over time. What $1 million could do 10 years ago is very different from what it can do today. Your loan stays the same in dollars terms, but the real purchasing power shrinks. If your property appreciates, your asset value increases and your equity grows. So if that property grows from 1 million to 1.8 million in 10 years, you are repaying a much smaller debt and owning a much larger asset. That's why older homeowners always look very lowly leveraged, not because they pay it off, but because time worked for them. Having said all that, we need to recognize that debt are dangerous when the cash flow is tight, the buffer are weak, the asset don't grow, and decisions are being made emotional. But debt can also become a powerful tool when cash flow is sustainable, you plan properly, and you choose the right appreciating asset. The goal is actually making sure that you pick the right asset that outgrows your liabilities. If this video make you pause and think about that differently, like and share it with someone you know. If you are planning your next move and want to understand how much debt is safe, whether upgrading improves your position, and how to stress test your numbers, reach out to me over here and I'll be happy to give you a free consultation. And if you want more grounded conversation like this, remember to subscribe to our channel. I make property content like this every week so that you can avoid costly property mistakes. This is Ron signing off. I'll see you in the next video. Bye.